Welcome back to ChalkTalk, where we take business, finance, entertainment, and education and wrap them all together for you, our viewer. Welcome to episode 8, part 2 of Palantir, on a deep dive of Palantir stock and how to invest in stocks. Thanks for watching. Welcome back.
Welcome back.
Yeah, now to the second portion of the video. We're still going to be talking a lot about Palantir, but now we're going to go a little bit deep dive into their stock and things that I look for, and I know that other investors look for because I learned from research, and now I'm going to maybe try to help you guys watching out at home is some things to look for in a stock when you're not just trying to trade it, or you're not just buying it because you heard about it on YouTube or Reddit, or your friend or your coworker told you this is the next great stock. Well, here's some things to look for. Personally, one of the good things that people look for, but you're gonna kind of take it with a grain of salt. It is a part of the earnings. It's the PE ratio, but you have to kind of be careful with PE ratio with tech stocks because, like I said, those numbers can be skewed because people buy tech stocks off of hype, not earnings. Mm-hmm. I shouldn't say that because Kathy Wood, obviously she added to position because of earnings, but like I said, people usually just get super excited about tech, like, oh, Elon Musk, he could have negative earning reports for 6 months, but as long as he's coming out with something cool and he's in the news, something interesting is always happening. Mm-hmm. People get excited about those interesting things in tech, and they buy. They'll buy negative earnings reports. So I don't really look too much into PE ratio when it comes to the tech industry, and they actually have I wouldn't say significant, but they do have a higher average PE ratio in that industry comparatively to other industries. So for example, an average PE ratio for I don't know, let's say an industry like 3M or Procter and Gamble or Merck and Co. A good PE ratio, I would say average is about 20, maybe 25 is hitting kind of like that high end. Mm-hmm. But with an average tech stock PE ratio is slightly over 26.
Okay.
So when you're looking at another company and you're saying like, oh, I want to buy into this retail oriented company or like a beverage company like Coca-Cola, you want to look for those 20. It's closer to an average for those industry. Anything under 20 is considered low. But tech, you have companies like AMD where their PE ratios are into the hundreds because people aren't buying off of those earnings. They get excited about positive earnings reports and you can see more buys, but people aren't buying tech so much off of about earnings. But it's something that you want to look at, of course.
Okay.
You don't want to buy a company that can go out of business after 2 or 3 months, or say, for example, 2 or 3 quarters. Oh, I just bought this company and now they just filed for Chapter 7 bankruptcy. Chapter 7 bankruptcy on the definition on the screen. You don't want that.
That's what happened to a lot of people in BBBY.
Yeah.
Filed Chapter 11 and are going out of business. If you go, I saw a couple of Bed Baths with like discount going out of business signs. So
yeah, I've been seeing those for a couple of months now. I mean, I hope they don't, but so here, I have 9 things I would say I overall look at. I'm not saying don't look at the PE ratio at tech stocks, but take it with a grain of salt. So here we're gonna put on the screen the first thing I look at here. Not in any particular order, but one of the things I look at here is you want to see cash flow, right? You want to see that the company that you want to invest in or are invested in has a positive cash flow. They can spend money healthily, in a healthy way. They want to expand. They want to grow their business. They need money to pay their employees. They need money to pay their bills. You want to see positive cash flow. So here on the screen, I have the operating cash flow in USD. Quarter by quarter from the first quarter of 2021, we have here a negative cash flow. But then in the second quarter, of 2022, we have an amazing cash flow pop of 174%, but then following that, we have two more negatives. So the company was obviously, as you could see, trying to grow a lot right there towards over these last 5 or 6 quarters, I think, which, like I had mentioned earlier in the video, that they've added a lot of commercial clients and contracts. So I think that's what a lot of their money was going to expand into new sectors and to expand into new what's the word I'm looking for? Into new industries, other than being in the private sector and being more involved, less involved with governments. So I think that's a lot of where their cash flow is. And you can see one of the reasons probably why many investors, along with Kathy Wood of ARK Investment Group, we have a 428% gain in the first quarter here of 2023 in their cash flow. So
Yeah, that's pretty impressive.
yeah,
Quite impressive.
over 400% gain on their cash flow. So they got a lot of money to spend. They got a lot of money to grow. Now let's just see what they do with all that cash. How are they going to grow? Let's see. But as an investor, I'd be pretty friggin' excited.
Yeah.
And here, next thing here, we have on the screen here for you to see a little bit more deep dive into the stock and into stocks in general. The second thing here, we have the balance sheet. Here, we're comparing the company's assets versus their liabilities, things that are going to help them grow and make more money, their assets, what they own as a company, versus their liabilities, things that is going to make cash flow, but not in a positive way, out of their company. What could potentially negatively affect the company? Your liabilities. Here, like for example, cars are a liability for people like you and me and people at home watching. A car is our liability. It's transportation. That's it. Not an investment. It's a liability. So things that the company, they need, but it's going to take away from their bottom dollar, their
bottom line.
Their bottom line. Thank you. Sorry, no English. No, I'm just kidding. And then here, the next thing, third thing on the screen we have is their income statement. Here we have a 2022 from the first quarter to the most recent from their earnings report. We have quarter by quarter, 2022 to the first quarter here of 2023. We have two positive income statements quarter to quarter. 121% at the end of the second quarter to the first quarter of 2023. We have over 100% gains in their income. So
insane.
They have over 100% in their income. And that's their net income, not just their gross. So this is what they're spending all that money, and they're saying, okay, cool, we paid off all our bills, we paid our employees, everyone's paid, we got their money. This is what we got to grow. This is what we got in our bank account, in our piggy bank. It's grown over 100% in the last 2 quarters. So they have a lot of positive cash flow. They have a lot of positive net income, and that's what investors like to see. People in the tech industry, like I said, they'll burn their money into the ground as long as they can hit that next great product, that next great software to make their company hype. So, all right, great. We're ahead of the pack. The tech industry is obviously like all industries, but especially the tech industry is extremely competitive nowadays. So, but now you have something that you have investors to get really excited about, which is going to help you grow as a publicly traded company. Next here on the screen, we have ROA. Return on asset. So now the company, they own other things like other companies potentially, or other things that are going to help them bring in more money for their company to grow. The company has assets just like we have assets as people. We own stock, we own homes. So maybe other companies, they own property, they own other assets, they own bits and pieces of other companies. So here, ROA, acronym, return on asset. We had a couple of negative, not too by much. Here we have at the end of 2022, quarter 2 and 3. Well, I should say mid and towards the end. We have two slightly negative at 19% and 15%. But at the end of 2022 and 2023, we're seeing those amazing numbers again, over 100% return on for their assets on their own investments from the company. So we got a lot of green going on. So I can see why Kathy Wood decided to add $13 million onto her position. There's things you want to see. You don't want to just blindly buy a stock because someone told you to.
Yeah.
You want the proof is in the pudding.
And there's the pudding. That's
And
a
here's the
lot.
proof.
118, add 115. I mean,
Yeah, those aren't really small numbers. I mean,
yeah.
it's good. Green is green, positive is positive, whether it's 5%, 50%, or 500%. But yeah, those are over 100% on multiple key factors that you want to see as an investor. You know,
Yeah.
so for me, I mean, like I said, I don't own any Palantir, but in the future, I really would
Yeah.
love to have a
It's
long
probably a good
position.
idea.
Something I would like to own in the next 10 years. I mean, I don't think this company's going anywhere. They've been around for 20 years. They seem to have a really
Yeah.
good board. They have all of the original, minus potentially three co-founders still involved into the company, still into this day. They're doing nothing but growing. They're adding into other sectors. They're adding into their commercial. They still have their private sector contracts.
Yeah, strong contracts.
Strong contracts. They're involved with the Air Force. They're involved with the Marines.
Very
They're
strong
involved with
contracts.
the British Health Organization. They have other
Oh, so they have that international footing,
yeah.
even more
They
so.
have international. They're also involved in Ukraine.
Okay.
Yeah. I
Mm,
personally
I
don't
don't
do
know.
too much of what's going on with their technology involved with the Ukraine, but they're also involved with that whole what's going on over in the Ukraine, as most of us are aware by now. But in the whole conflict, I don't really know how directly involved their
Yeah.
technologies are being used, but I have heard a couple of things that they
I
are.
mean, Department of Defense.
Yeah, and they are involved in data analytics and predictive
Mm-hmm.
analytics. So,
Right.
military wise, predictive analytics could be very helpful.
Mm-hmm.
Your enemy, what's their next move?
Right.
I'm assuming.
That's the
I
new. That's the new warfare.
yeah, yeah, AI and
AI,
artificial intelligence to
technology,
predict next
robots,
moves.
drones,
Yeah, your next move, whether it's your consumer of Amazon. Actually, yeah,
intelligence, essentially.
yeah, and then here we have one of the last things I'm going to look at, other than the actual stock prices. Here we have the EPS, earnings per share, and here we have quarters 1, 2, 3, 4, 5 quarters from 2022 up until here. We have 2023 quarter 2023 in the screen, but they haven't released earnings yet because we're not in the second quarter yet. But as you can see here on the screen, quarter 4 of 2022 and quarter 1 of 2023, we got a positive EPS. So, yeah, all positive numbers. But now you ask yourself, where do I get in? What's a good price to get in? So what I generally do is the next thing I look at is I look at analysts' price target. And they have 3 price targets here. I'm going to put this up on the screen. Sorry for everything on the screen. I just want everybody to be able to follow me along at home watching. As you watch this video, you're getting everything that we're looking at here for you at home. So as we see here, the analyst price target, we have a high, average, and a low. Last week we closed at 11.71. We're trading over $12 per share right now. Analysts have a high price target of 15, an average of 8.98, and a low of $5. I went to Yahoo Finance and they have a price target of 8.98. So a little bit, actually, it's exactly here what the average is overall analysts' price target. But again, we got to take that with a grain of salt. It's trading more than $3 right now, and then they have their high of 15. So what I like to do is I like to go in at the 52-week, and I look at the low, and I look at the high. And I take those two numbers, and I add them together, and I divide it by 2, and I come up with my 52-week average. The Palantir has a 52-week average of $9.17. So between here we have a Webull analyst's price target that you're seeing on the screen, and the Yahoo price target is just under $9. So it's about roughly 19 cents under the 52-week average. So they're pretty close to the 52-week average. I think they're just playing it safe with that average. And then here we got 2 more things to look at here about the stock. Is you want to see how many people who actually hold that stock, right? How many people are actually in profit? Well, out of the total profited shares here, we have 88.3% of the people who own that stock are in profit.
That's It's quite.
So it's a
This
good
is
sign.
quite impressive stock.
Yeah. And here we have one of the last things I would suggest looking at, or not in any particular order, but in general, as with this video, the last thing we want to take a look at, and I would suggest it to be one of the first things to look at, is the cost distribution. What all of the holders from retail to investors like Kathy Wood to people who like BlackRock, Vanguard, Bank of America, all those high-end investors, all those big firms that you see, all those numbers together, all their price averages together, we have an average cost distribution of 963. So, which is about 65 cents over the analyst price, the average analyst price target, and roughly, what's that, 919 minus 63, so about 44 cents over the analyst price target. Here we have the average cost ratio of 963. But with that number, 88% of people are in profit. And actually probably more this morning with it trading over $12. So yeah, those are some of the things that I look at a stock and within a stock. And we have Palantir being our example today.
Palantir, not Peloton.
Palantir. Tech.
Tech, AI.
Not a bike.
Kathy Wood. Strong stock. Strong company.
Yeah. But other than that, I would say, other than the things that we talked about today and that you saw on the screen, I would say to look at would be the shares outstanding versus the free float. The shares outstanding, we'll put it all this definition like I've been repeating myself over and over. I just want to be thorough. Is that the shares outstanding is the amount of shares that the company has available to them to release to investors. And then the free float is the amount of shares that have been released. You don't want to see a massive discrepancy in the two because the company, in order to get money, could release more stock, dilute it, and next thing you know, you're down 20%. So you want to be careful. It's healthy to have more of shares outstanding, of course, than of your free float, which again are the shares already out into the market. You want to see a little bit, but if you're seeing this massive difference between free float and shares outstanding, you got to be a little careful. And I would say be ready to make another purchase or two potentially down the road if they do release those shares. It is going to dilute the float. And when that happens, we usually see a drop down in price. So if you do buy a stock, be careful with that number, because that could be one of the reasons why you end up going down into the red. If that company does so happen to release those shares into the market.
Okay.
But yeah, other than that, I'd say, I mean, it's a lot to look into. It's a lot of numbers, but if you're serious about investing and you're serious about growing your money, then you'll put in the time. But I hope some of this information helped all of you at home. And yeah, thanks for watching.
Thanks for watching.
Thanks for tuning in. We'll see you in the next one.
Exactly. Oh, yeah. Like, comment, share, subscribe, and leave your comments and any questions.
Yeah,
and
leave
any
some
requests.
comments.
Yeah.
We'll talk back.
Tell us how bad we are. Tell us how good we are.
Tell us if there's anything you want, anything you don't want.
But other than that, have a great day. Have a great everything.
Have a good morning, a good afternoon, and a great night, and we'll see you in the next one.
Bye.
Bye.